Hello, I'm Jared Nelson from the Investing Channel, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. The only thing that mattered last week was the Fed meeting. Investors waited with bated breath on how the central bank intended to deal with the bond rout. So far, the chairman managed to steady the ship. No further implosion in the treasuries, and stock markets remained at an even keel. In the FOMC statement, the Fed says it aims to achieve inflation moderately above 2% for some time, and expects to maintain an accommodative stance of monetary policy until these outcomes are achieved, meaning no rate hikes in the foreseeable future, at least until 2024. Given the accommodative Fed stance, does it mean that the bond slump is over? For traders, the key question is whether they should go contrarian and buy treasuries amidst the increasingly chaotic sell-off. To answer this question, we need to look at both sides of the issue. We start the debate with an affirmative yes. Above 1.7%, a level seen recently, long-term treasuries are producing coupons that are more attractive than in the recent past. The last time long-dated bond yields traded this level was back in January 2020. Many portfolio managers might be tempted to lock in these yields for their long-term portfolios. And should we get an unrelenting rise in the bond yield, a rise that leads to a sudden sharp sell-off in the stock market, the Fed might be forced to resort to yield curve control. Yield curve control refers to the control of the level of interest rate along parts of the yield curve, such as the 10 or 30 year. If a stock market were to crash, the fragile economic recovery may be lost. The central bank would certainly not want that. That said, bond prices are unlikely to rebound all the way back to the 2020 highs. That peak was caused by the utter panic induced in the early days of the pandemic. A fear-led bond buying of that magnitude is unlikely to repeat anytime soon. So, for those wanting to buy treasuries now, this is a trade with limited upside. Not only that, buying bonds now is like catching a falling knife. Long-term treasuries are heading for the worst quarterly performance since the 70s. A sustained bearish trend often triggers stop losses and causes momentum traders to jump onto the bandwagon, leading to a further price decline. Moreover, the Biden administration just passed the $1.9 trillion COVID relief bill, and a further $3 trillion package is being floated too. This brings the specter of higher inflation rate. The Fed forecasts that the U.S. economy will expand by an astonishing 6.5% this year. Real, not nominal. This is a huge growth number. When the economy is growing this strong, you really don't want to be in the bond market unless you have to. Why? Think about all the other opportunities available to you if the economic growth were this strong. Company earnings will rocket, dividends will rise, and liquidity will be plentiful. This will certainly lead to more stonk bubbles and GameStop-type short squeezes. And commodities will be strong too because of the rise in demand. Many emerging markets will outperform because of their high beta characteristics, as will small-cap stocks. Who knows? A booming economy may lead to a resurgence of value stocks, especially in Europe. All in all, there are plenty of options outside bonds. And remember, the Fed is in no hurry to raise the Fed funds rates. So the real interest rate will continue to be negative and eat away the real purchasing power of bond coupons. Investors know this. That's why they are not scurrying back to bonds now. Perhaps they are waiting for the bond sell-off to exhaust its downward momentum. Perhaps they are waiting for the Fed to control the yield curve. Perhaps investors are waiting for the third COVID wave in Europe that will lead to a more bearish assessment of the global economy. One of the basic rules of chart reading is that we assume a price trend is more likely to continue than reverse. Based on this principle, we suspect that bond prices will continue to weaken throughout the year. But bond markets will enjoy a counter-trend rally from time to time. This will fit the Fed's orderly narrative. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. Remember, make sure you do your own due diligence before making any investment decisions.